Hello and welcome back to another episode of the Investor Financing Podcast. I'm your host, Beau. We have a great show. We're going to talk about real estate investing. We're going to talk about creating a fund to invest in syndications and what that entails, and whether you want to be a passive investor or you want to be a general partner in the future. Usually, most people get started as a limited partner. In these transactions. It's a great way to learn the business and then progress from there. And our guest today, Lisa, she's a real estate investor that's passionate about investing passively in commercial real estate opportunities for a combination of cash flow and long-term appreciation. She's a CFO at a tech startup company in real estate space. She's a former CPA for 15 years at big companies auditing billions of dollars. So she knows her numbers. She's probably very analytical. Originally from the Cayman Islands, right? The first person I've ever met from the Cayman Islands. I see all the National Geographics with all the wildlife, and the Cayman Islands is amazing. And now you reside in Southern California. And we were chatting before we went live. Have a very interesting background, and I was learning a lot as we were talking about why real estate syndication makes sense, and the ultimate goal, I tell this to everybody, the ultimate goal is that I have enough cash to deploy in other people's syndications, right? That's the ultimate investment. It's like, you're not the operator, you have enough cash you can just redeploy, or you're a busy working professional, right? You're a W-2'd, or you have your own business and you make lots of money and you just need tax write-offs and you need to grow your wealth. Syndication makes total sense because a lot of these assets, they're doing cost segregation. You're getting and better than I do, being a CPA, former CPA, that there's a lot of advantages for, depreciation on these assets. So a lot of these people you wonder why the Donald Trumps of the world, right? Everybody complains, hey, you're not paying taxes. It's because they're doing, I don't know what he does exactly, but they're depreciating these assets, and they're accelerating the depreciation through cost segregation. And even though they made a couple $1 million last year, they had a couple $1 million more of depreciation losses. So it's just an amazing tool that a lot of people in the corporate world never get involved with. And that's why we do these shows, right? We bring on guests to talk about things that you might not think about and go, wait, that does make sense. I do have a lot of colleagues that are accredited investors, and they're always looking for opportunities. They just don't have time. And that's what Lisa came to realize years back. And then she started investing as a limited partner in syndications, and she's been a GP in a syndication. And now she's really, as I was talking to her, she really knows this space, and she helps people kind of do what she's doing, or at least learn the fundamentals if that's something you want to do, or potentially they like what Lisa's doing and they invest with her and her fund. So it's very awesome business model, which can help a lot of people, and it totally makes sense. So welcome to the show.
Awesome. Thank you so much for having me.
Yeah, no, it's great. Like I said, I was learning a lot before, and I love the business model, and I think syndication and buying bigger projects makes more sense. If you talk to any real estate investor, it's all the same story. They started with single family homes. They might have done some flipping. They might have bought some duplexes and fourplexes. And then they go, wait a second, I'm never going to reach my cash flow goals by buying these smaller properties unless I buy hundreds and hundreds of doors. And most of those people evolve into doing syndications, right? Because that's how they can get results faster. So I guess today's real discussion is, can you kind of take us back to the first deal you invested in as an LP? And what really transitioned in your mind for you to say, okay, this is the place to be?
Yeah, so I think before the first LP investment, what prepared me to make an LP investment was my investments prior to that. So I grew up in a real estate family. My father was a contractor. He built 14 apartment units when I was a child. So throughout my childhood, I was involved in cleaning apartments, property management. We still have those apartments today. So ongoing property management for over 30 something years. And then when I came out of school, I bought my first place. It was a 2-bedroom, 2.5-bath townhouse. And I bought it because I loved it. I didn't fully understand numbers and my parents weren't really big on like real estate investing as a business. It was just they fell into it, and that's just sort of what they did. And it was more like, hey, make sure you go to school and get a good degree. So I bought that place, 2 bedroom, 2.5 bath in Grand Cayman. And that property, I held on to it for a total of 6 years. I spent the first year I was in the country, and then every year after that I was out of country landlord. So managing it from a distance, and I didn't buy it correctly, so I bought it for too much money. So as a result, the rent that came in was less than the expenses that went out. And that it broke even the first year. And then that reality of the rent being less than the expenses was the reality for almost 5 years after that. And, that was my education and my first primary education in real estate investing. And by the time I had then moved from Cayman to Boston, then to LA. While I was in LA, I got an email for over $1,000. The AC had broken down. The company came out, fixed it, and sent me the bill. And I was like, you know what? This property has got to go. Like, it doesn't, cash flow, and it's sending like $1,000 bills. Like, this is just too much. So once I sold that property, I was like, you know what? No more real estate. And I always tell people that life has a sense of humor, because about a year or so after that is when I took a job working as a controller in private equity real estate funds. And 6 months in, I said, oh my goodness, people are making money investing in real estate. You just need to know what you're doing. And clearly I had no idea what I was doing the first time. And that's what re-energized me to start back again. And I started, you used to live in California. We were talking about the prices. I started with thinking about buying a property here in California, in LA. And like everything was like crazy expensive. And that was like 4 years ago. And I said, okay, let me look at turnkeys. And I was looking at that for about a year or so. And I was just like, there's just something about this that just doesn't make sense to me. Like, trying to do all these turnkeys from outside of California, all these different markets. So by time I was introduced to syndications, I had exhausted a lot of these other avenues sufficiently so that syndications made sense. It made sense to me that it was a passive investment. It made sense to me that, these were high quality deals with high quality operators. I feel that if I was introduced to this type of opportunity earlier than the time I was introduced, I would not have fully been able to appreciate or understand what the opportunity was providing. And it's all about timing. So that's what I would say to that. So to now go to your question, which is my first investment, was in 2019. I invested in a 600 unit apartment complex that was in Atlanta. And the person who presented that deal to me, I met them like haphazardly at a personal development program about a year or so before. And we began to be friends. And through that time is when I got to realize that she was a syndicator. And I was so intrigued because it was like, this is very similar to what I do for work, but like the work stuff is like all institutional investors, and whereas this is like everyday people. And I was like, wow, like, is this possible? And, that just sort of blew my mind. And that was the first entrance into it. So I had that opportunity. I invested in 2019, first one, 600 units, another 250 units in the fall of that year, which was also in Atlanta, but a different operator. And then each year since that time, I've invested in 2 projects per year. The first 2 projects have gone full cycle now and have actually sold in 2021, giving back all the money with returns, and then rolled into new projects. So yeah.
Awesome. And then, and now you're helping others invest, so they can participate with you as an LP in your fund, right? Is that
right? Yes, that's correct.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, Beau Eckstein here, and I want to thank you for being a patron of this YouTube channel, or if you're listening on iTunes, Stitcher, or any of those audio platforms. I want to give you my book for free that I just wrote. It's called Launch, Expand, or Buy Your Next Business Using SBA Financing. And you can simply go to thesbabook.com and you can receive a free copy of my book. That's thesbabook.com. And thanks so much for being a valuable listener or viewer of the show. And I hope you enjoy the book. It's a very short book. It goes into detail. You can read it very quickly and get a good overview of all the benefits of using SBA financing. So thanks so much, and I'll see you soon. Now, this is for somebody that is green, usually, or somebody that just doesn't have time, right? They don't have time, and so what you're doing is you're basically vetting we call them the pony or the sponsor or the operator, right? Yeah. And you're looking and looking at like, okay, based on our kind of buy box of what we're interested in doing, what markets we like, what asset classes we like. You're going through and doing as much due diligence as you can. Obviously, the people that invest within this fund, they're getting all the documents to review because they're making a decision as well to invest in it. But they're really what you're doing is becoming kind of like, and I hate to say it, it's like a mutual fund, really, right? Like, but it's a better. There's less fees for them. There's tons more upside.
Right.
There's depreciation, but really, it's like a basket per se that they could invest in different asset classes. So they could put 50, 100 grand in this one, 100 grand in this one. And obviously the accounting's gonna be all separated on each syndication. But I like that because then it gives people, I mean, I think it really comes down to people usually with money don't have much time to, unless they're to a point where they have a lot of money and they're retired. But the working people that are making a couple $100 grand a year, maybe have a couple $1 million in assets, but they're busy. That's really the avatar that you're looking forward to. Like say, hey, come with me. Or maybe somebody that just like wants to learn the business, but they want to be their handheld a little bit. So then they would invest. Because, right, like most people start as a limited partner anyway, when they want to get into syndication to learn about the PPM
the process
and all
everything.
The process so
I would say a couple things to just share there is, first of all, so my fund, I would say my fund is primarily for people who are seeking diversification. So how I decided to, like, the genesis of why I decided to create a fund, I was looking at my own self, as someone who is an accounting and finance professional, still working the whole 9 yards and wanting to invest in different real estate opportunities. And my reality was that because I have a business in this space and I have a podcast as well, like I have tons of and I go to the conferences, the real estate conferences. I know tons and tons of operators, and my deal flow is like very full. Like there's always tons of people who have deals and opportunities for capital and deploying capital and the whole 9 yards. But I noticed that a lot of deals would have a minimum investment of like 75, 100, 200, 250, even $500,000 sometimes. And really good operators, really good deals. And I didn't want to put all of my money into just one deal. And I thought to myself, well, if I feel this way, I'm sure there are other people that feel this way as well. And that's where I decided, well, could I create a fund that's not blind, but would enable people to come in and choose, hey, like this investment is an opportunity that we're offering. Do you want to invest in this particular one? And here is the minimum investment. And it's lower than the investment that you would have going directly with that particular sponsor. And being able to, sort of go from that point of view and give people more diversification across different asset classes. If that person has $100K to invest this year, instead of all of that money going into just one deal, that could go into 4 different deals. To me, I think that's safer for your money because it's across different operators, especially if each operator you have vetted and trusted and you know that they're really good. and it's different asset classes, different markets. I think it's very powerful.
Yeah, that is very powerful. I was really thinking about it when you're saying. I'm like, I love it. It just makes sense. It's like if you have 100K this year that you want to invest, and like instead of putting in one deal, and what if that deal doesn't perform to expectations? Now you invested 25,000 in four deals, and your blended return is better or potentially
Right,
better,
potentially.
or it also hedges downside risk.
Right.
And that's why people like that. So, right, like you got to look at it as like a diversification. I mean, at the end of the day, you have to have multiple streams of income. You have to
Yes.
diversify. Like if you're if you love stocks or Bitcoin or whatever, you shouldn't have all your money in one asset class, because what
Right.
happens if that asset class stalls and or does poorly
Exactly.
for a few years? I mean, real estate historically is always going to be a good investment, but there's some times where it gets tough, and so like
Agreed.
yeah.
And I think even so, you can even diversify, as I said, markets, asset classes, but even like debt, like your mortgage, you're in the mortgage space, right? Like already I can see like deals will come to me. Some of them are bridge with flexible rates. Some have gotten a cap. Some have chosen not to get a cap. Then you have some properties that have more permanent debt. To me, I don't think there's a right or wrong across all of them, because like if you're doing extensive value add, then I can see the bridge and on and on and on and on. But like I think that's like another element of diversification, that you don't have all your eggs in the same basket, because you have some that are impermanent. Then you have some of your investments that are in bridge debt vehicles. So you just have that mixture that helps you, like in case the economy goes any kind of way, you feel fairly confident, that you're in a good spot. So
Yeah,
yeah.
yeah, and I mean, who would have guessed right after COVID that now all these syndicators look like geniuses, right? Because like they bought a building last year for $34 million. Now they're selling it for $62 million, and like
Hmm.
it's a weird time for sure. Like, and the fact is that I think the last couple of years have been kind of like historic as far as returns. That
Right.
most investors should realize that this is not realistic for the long term. Like, you're not going to see 20% rent growth like a year for like 5 years, like we have. You know what I mean? It's just been
Sure.
insane. But long term, we know there's a shortage of inventory.
Right.
People need rental properties. They need rental. They need places to live, and so it's a good asset class to be in, and it's really multifamily syndication is a team sport versus like going out and buying a duplex or fourplex.
Right.
And plus, you don't have to get involved with borrowing the money or doing anything as a limited partner. You're really just a limited partner, but you get
Exactly.
all the benefits pretty much as a general partner.
Yep.
Except you're not doing as much work. You're really just a silent investor per se.
Yeah, and it's just good to diversify. Like some of my investors are active investors themselves. So they have active portfolios, either short-term rentals or smaller multifamilies and stuff like that. And they choose to invest in syndications in addition to doing those investments, because they're diversifying. They don't want to be having to work on every single real estate that they have in their portfolio. They just have some real estate that is completely passive, and then some that is active, which works out to be very good, because that enables you to qualify to be potentially a real estate professional, depending on the amount of hours that you're able to put into your personal portfolio, which then supercharges the passive losses that you get off of those syndications, because then you have the ability to use them to the extent that you meet the requirements of being a real estate professional.
Yeah, I mean it's huge to be and that's one advantage of owning a short-term rentals. If you materially participate in
Right.
this, and then you can get some of those benefits like you were almost a real estate professional, because you can do the cost
Yes.
segregation and offset some of your earned income. Like, I try to tell people this all the time, like, you guys got to be like paying attention to this, because this is like I showed my friend this. He he went out. I talked to him yesterday. He bought like four properties for Airbnb
Nice.
in the last 18 months or 15 months. He converted one rental he had to an Airbnb. So he has five Airbnb properties right now,
Wow.
and he's crushing it. Like, netting thousands and thousands of dollars a month, where he can stop working right now. And he
Wow,
did it.
that's awesome.
I mean, he had a couple $100,000, and he invests in syndications too. But I passed along a cost segregation information to him, and then I said, watch this video about the loophole. I don't know if you want to call it a loophole when you materially participate in these short-term rental properties. And anyways, he offset a couple $100,000 off of his income.
Nice.
And like, this is for people out there. It's like, this is why we do these shows. It's like, I love interviewing people because I'm always getting nuggets, right? Like, I'm learning. Like today's nugget is like, okay, you have a program where you're helping people do what you're doing as far as, building these funds, right? And giving them like, hey, here's the context you need. This is what you want to do for CPAs. I mean, this is like, for me, somebody like me, I'm experienced in real estate. I have connections. Like I could see myself doing what you're doing right now. And I'm like, why aren't I doing that? And so
yeah,
you're
it's
helping
very powerful.
Yeah. I mean, it's like,
I think the other argument for funds is, one, it helps you to protect your investor's identity. It helps you to strengthen your own relationships with your investor base. And then it keeps you outside of the SEC, like it keeps you in compliant with the SEC rules and regulations because you're taking care of your own entity. Many times when you have just a bunch of co-GPs and like if people aren't materially participating or it's not clear what they're doing, like it can raise flags to the SEC, which, no one wants to be in those situations. So this is just one of the ways that you can play more cleanly and, have full control over your entity.
Yeah, no, it totally makes sense. So what are your plans for like the rest of the year, 2022?
Yeah.
Are you actively,
Yeah.
if you don't have a per se a deal right now that you're looking at?
I do have a deal right now, but
okay.
yes.
So, but with the model you have, you could always be
Correct.
raising, and
That's
always
right.
they can subscribe, so they don't need to put their money until it's
Correct.
identified.
Yeah, I don't take any money until deal is identified and there is an opportunity and you want to go into that opportunity. So right now I do have an opportunity. It's a 408 unit apartment building in Charlotte, North Carolina, value add class B. And yeah, so that one in terms of returns around between 13 to 15% is the IRR on there and 1.7x multiple, 5-year hold. And the debt on that is actually permanent with a fixed rate of 3.3% interest rate, which is awesome.
Yeah, they must have locked in a long time ago.
Yeah. So definitely. So that's what's going on right now. That will close sometime in early June. So opportunity for investors, only accredited investors, minimum investment is $25K. So that is an investment that's going on inside of my fund vehicle at the moment. And as we talked about earlier, I am also doing a fund manager accelerator. So the boot camp is on May 21st, depending on when this airs. But like if it doesn't air until after that, the boot camp will turn into an evergreen course, which will just be called the Fund Manager Accelerator Crash Course. That will have just the same price. It's just $50. People are able to go in, get a rundown of how they can go ahead and start their fund. What are the things that they need? And then they also get connected to all the who's, and I've been negotiating with all the different who's, like prices, special prices that they can give discounts to students, to be able to set up their funds on the various platforms or with the different real estate attorneys and accountants as well.
That's awesome. I love that. We'll put the link below. We'll get this to air before that, but then they can go to that same link, even if it's after and they watch it 5 months from now. They can pay only $50.
Yeah, it's only $50 right now.
That's super good. I'm going to register. That's like $50. That's perfect.
Nothing.
No.
That's nothing. That doesn't even fill your tank. Well, in California, it doesn't.
No, here, I have like a Ford Expedition, one of those big SUVs, and I never drive it. It's like an old truck, but I keep it because I don't want to sell it. I just filled it up yesterday. It was like $123.
Yeah.
And it's like, wow. But, that's why most people are working remote now. It's like,
Yeah.
I couldn't imagine having to work in a corporate office. I mean, there's certain things you miss, I think, about like having coffee with people and like going to lunch and like, but you can still do it. And so I don't know. I love working at my house. I just put a dress shirt on, but I'm wearing casual shorts and nobody knows, like it's like perfect. It's such an amazing world we live in right now. Everything's at our fingertips. We have this Zoom, and now I can produce a podcast and it goes out. Thousands of people see it and all that stuff. So we can find more. Your podcast is the name.
Yeah. So one-stop shop to find out more about me. Podcast, everything is lisahylton.com. And that's Hilton like the hotel. Only thing with a Y. So lisahylton.com has my podcast, The Level Up REI. Tons of blog articles. It also connects to my YouTube channel, which is Lisa Hylton. Very simple. And then I'll also give you the website link for people if they're interested in checking out the upcoming boot camp, which will ultimately turn into the crash course. I'll also provide you with that link so that way they can have that. But it's also lisahylton.com/fund accelerator, but I need to double check that. So I'll definitely give it to you so that way you can have it.
Yeah. Well, thank you so much for sharing so much information. And it was a pleasure meeting you. And hopefully we can do another podcast in the future.
Awesome.
And dive into different, kind of dive deeper into this whole model. And I'm really interested myself. So this is great.
Awesome.
So anyways, everybody out there, I hope you enjoyed this episode. I try to bring on really awesome guests to discuss topics in real estate investing. And this is another great topic because I think it could be good for somebody that's looking to invest as an LP. It could be good for somebody that's looking to do things that like what Lisa's doing, and just to open your mind to diversification and like, hey, instead of having to put $100K into a deal, which is a lot of money to most people, $100K is a lot of money to most people, and the average there's like 70% of the working the hourly workers in America have less than $400 in their account. So, this is all about growing your wealth, people. We gotta do it together as a team, and so that's what these big institutional investors are doing now. Look at what they're doing. They're coming in and buying single family homes. So the American dream of home ownership that's gonna like disappear. It's a interesting time.
Yes.
And what you realize about like where we live and what the world's coming to is that you have to have an open mind and you have to take action on whatever you're going to do, because if not, it's going to be very difficult. I feel for people that are, hourly and don't have any assets or anything, like they don't own rental properties. They have this is why we do this. I mean, then there's beautiful things where you hear people that like, scaled and grew from nothing and now make thousands of dollars passively, a month. So it's out there for everybody. It's just whoever's going to take action and, plug into podcasts like yours, like mine.
Correct.
And $50 to go to your accelerator and I can learn, get a foundation of how to set this up like you're doing. And I'm off to the races. It's like cheaper than a tank. Yes, that's right. Well, thank you so much. It's been such a pleasure.
Welcome.
All right, guys. Thanks for watching. See you on the next episode.